All right, welcome, founders. So imagine you've got this world-changing idea, right? Maybe it's the next Uber, the next Airbnb, or some revolutionary AI company. You've got the vision, you've got the drive, but there's a massive hurdle right in front of you. You need millions of dollars to actually build the thing, hire a killer team, and reach your customers. But, you walk into a traditional bank, totally confident, and without a proven track record or a ton of collateral, they won't even touch you.
So if traditional bank loans are just completely off the table for a brand new company with zero revenue, we have to ask the ultimate question. Where do successful startups actually get the cash to scale? How do you fund the dream? Well, today we're putting together the ultimate explainer for you first-time founders out there looking to secure your very first major investment.
Think of this as the ultimate founder's playbook. We're going to quickly hit why your startup needs cash, how venture capital actually works, the funding roadmap, what VCs really want from you, and finally, weighing the trade-offs. Let's dive right in.
Section 1. Your startup needs cash.
Because, let's be real, passion alone doesn't pay the server bills. You need serious capital to turn that innovative idea of yours into a global business. And the go-to solution for high-growth startups? Venture capital, or VC. Now, the absolute crucial thing to remember here is that this is not a loan. No way. You aren't making monthly repayments with interest. Instead, venture capitalists invest money in exchange for ownership shares. It's really a partnership. They hand you the capital to grow at warp speed, and in return, they become part owners of your baby. They're betting big on your success because, hey, if you win, they win. But if the company goes under, they could lose their entire investment.
Moving on to Section 2. How venture capital works.
Now, what's super interesting is how this transaction actually plays out in the real world. So let's look under the hood at the financial mechanics of your very first deal. Let's run a quick scenario. Imagine you've coded this incredible, groundbreaking app. Right now, it's all yours. You own 100% of it. But to truly scale it up, to hire a dedicated dev team and launch a massive marketing blitz, you need exactly $1 million.
Enter the VC firm. They look at your app, absolutely love the potential, and agreed to hand over that $1 million. But here's your new reality. They take a 20% slice of the pie. Boom! You now own 80% of your company, and the VC firm owns 20%. Yes, you just gave up a piece of your company, but you now have the war chest you need to grow way, way faster than you ever could have on your own.
So why exactly does a VC do this? Well, their goal is incredibly simple and honestly highly ambitious. If they inject that cash, help you grow, and your company eventually explodes into a runaway success worth, say, $100 million down the line, well, their early 20% investment just turned into $20 million. That's the magic trick. That is exactly how venture capital investors make their money, buying in early and holding on for explosive rocket ship growth.
But here's something every first-time founder really needs to hear. You are giving up equity, sure, but in return, you're getting so much more than just a giant check. The best venture capital firms out there provide massive value beyond the cash. We're talking invaluable business advice, deep industry expertise, and serious help with strategic planning. And honestly, the biggest perk? You get plugged straight into their network. We're talking valuable connections to partners, elite clients, and crucial access to future investors for your next funding round. For a young startup, those connections are often literally just as critical as the money itself.
All right, Section 3, the funding roadmap.
Because raising capital, it's not a one-and-done deal. It is a full-on chronological journey. Let's map out exactly what that path looks like, right from your initial light bulb moment all the way to a massive exit. It usually kicks off with seed funding. This is super early stage. Maybe you just have an idea or a rough prototype. That seed money goes toward initial product development and market research. Then, once you actually prove customers want what you're building, you graduate to Series A, using those funds to really expand your operations. After that comes Series B. At this point, the business is growing like crazy, and you need cash to scale and dominate entirely new markets. And finally, you hit Series C and beyond. This is the big leagues, where the focus shifts to massive global expansion, buying up competitors, or even prepping for an IPO to hit the stock market.
Which brings us to Section 4, what VCs want from you.
To successfully navigate that whole roadmap and lock down your first big investment, you kind of have to flip the perspective. You need to look at your startup directly through the eyes of the investor sitting across the table. And the most crucial point here, it's the math. Investors are taking a massive, massive risk on an unproven company. Because of that, they are definitely not looking for a safe, steady 5% return. No way. They are explicitly hunting for companies that have the potential to return 10 to 100 times their original investment. They literally need those exponential winners to make up for all the other startups in their portfolio that will inevitably strike out. So to figure out if you're that next exponential return, they evaluate you against a pretty strict checklist. Before you ever pitch, you better make sure you can answer these 4 things. First, does your company solve a real, genuinely painful problem for consumers? Second, is your market size big enough to actually support a billion-dollar company? Third, do you have an incredibly skilled, rockstar team capable of actually executing this vision? And lastly, does your business model show the potential to grow incredibly rapidly? If you can confidently check all those boxes, you're speaking their language.
Finally, let's wrap up with Section 5, weighing the trade-offs.
Look, before you pop the champagne over that term sheet and accept millions of dollars, you really have to understand what you're signing up for. Venture capital is the ultimate double-edged sword. On one hand, the advantages are immense. You get massive funding without those crushing monthly loan payments. You get expert guidance, top-tier networks, and the ability to grow at absolute lightning speed. But all of that is directly countered by some heavy realities. You suffer an immediate loss of ownership. You now have investors who can and will influence major company decisions. You might face serious disagreements about strategy. And maybe the toughest part? You are now under relentless, high-pressure expectations to grow. If your growth stalls out, the pressure from those investors is going to skyrocket.
It is without a doubt a high-stress path. But remember this, venture capital is arguably the most powerful tool in the world for startup growth. Just think about today's tech titans. Companies like Airbnb, Uber, Facebook. They all relied on this exact trade-off in their early days. Without giving up that equity for investor capital, they would have grown so much more slowly. And let's be honest, they might never have become the global phenomenons they are today.
So as a founder gearing up to seek your very first investment, you really have to look inward. Now that you understand the incredible advantages of having the resources to build your ultimate vision, paired with the heavy loss of control and the intense pressure to perform, I'll leave you with this final provocative thought for your own startup journey. Are you willing to trade away a piece of your dream today to guarantee it scales to the world tomorrow?